Thanks for joining us today and coming to the re-recorded version of the market call. So without further ado, I'm going to share my screen and we'll get right into it. Basically what we talked about in the last call. So just wanted to give you guys a quick update into where we are as far as the company. We are now over $100 million in inbound AUM since we launched, or I wouldn't say launched because we haven't launched yet, but since we made it known that we're doing what we're doing and we're building the platform for alternative investing, commitments are going fast. If that's of any interest, feel free to reach out and we can talk about it. So let's start with the market update, what we don't normally do. We can see that global money market flows are still fairly high. Basically, there's a lot of money still standing on the sidelines at 1.7 trillion. Not much has changed since we actually did the call last week. There was a little bit of a move down in the market that was immediately bought back up, partly due to the fact that there's just so much money out there. You can compare this to the global money market flows in history. 2020 ended up being I think the biggest year ever, with about $1 trillion going into money market funds. Still quite a bit in 2021, just a little over the halfway mark compared to other years. For example, post-recession, where money was going into the market, you can see there was withdrawals from money market funds, etc. So that is happening actually when the trailing PE ratio, the Shiller 12-month trailing PE ratio, is sitting just shy of 30, which is the highest ever recorded, just on par with the tech bubble. To remind you, the average PE ratio over the last 130 years or so has been 14.9. So
two quick things. The first is, can you remind me the difference between traditional PE ratios and a Shiller ratio?
Right. So traditional PE, or forward guiding PE ratios, are what analysts expect is going to happen in the next 12 months. And Shiller PE is what actually happened in the prior 12 months.
Got it. So it's backwards looking. And is it also safe to say that, hey, if all this sideline money actually found its way back into the markets, we could see this go even higher?
Yeah. And I would also say, there's a baseline effect too, that some companies saw their earnings decline during COVID, and it's coming from trailing 12 months may have the COVID impact in it, and in the front view mirror, it's going to disappear. But at the same time, we've seen a lot of tech companies' earnings improve dramatically because of COVID at the same time. So those kind of offset each other too. So it's just an interesting place where the market is and where it could go from here. So talking about that point, passive investing, vanguarding effect definitely had an impact into what we call the breadth, how wide stock market distribution is as far as where the capital is going in the stock market. So this is the total market cap of the top 5 stocks going back here to the 90s. You can see what they were. So let's say in the peak of the dot-com bubble, it was Microsoft, Cisco, GE, Intel, and ExxonMobil. And now it's Amazon, Apple, Microsoft, Amazon, Google, and Facebook. So what's happening right now is that we actually only have tech companies as the top 5. We don't have Exxon, which for a very long time was the world's largest company. If you're looking here at 2008, only a single tech company was in there, which was Microsoft. Actually, good for Microsoft. They've been top 5 companies now going back over 30 years. And almost at $9 trillion is this market cap of the large 5, which is just north of 30% of the entire S&P 500.
That's incredible.
So a quick update into the banking system here. Post 0809, the Fed goes into the quantitative easing programs and puts a lot of money into the market. So you see total loans and leases actually decline 0809 as lending becomes more stringent and loan demand weakens. But at the same time, the amount of deposits increase. That's the beginning of the QE era. Prior to the QE era, the loans and deposits were basically on par. Whatever total deposits would grow, so would loan demand. That makes sense. That's a healthy system. So the Fed started breaking the system here with the QE policy. And then post-COVID, loan demand is actually weaker still as of June, but deposits have just exploded. So it's a very interesting ratio right now that banks are almost sitting at 2 times the amount of deposits, it's 17 trillion, than they are in loans. So there's $7 trillion of cash just sitting there on these balance sheets.
So what's the point of QE if the money's not making it into the system in the form of loans and just sitting in bank accounts?
So John Maynard Keynes used to call this the liquidity trap, where at some point, yields are so low, money is just sitting in the bank. There is no point in going into the bond market because the yield's too low. But just adding to that inflationary debate, if interest rates do rise or something does happen, there's a lot of potential money in the banking system that can still come out and dramatically impact the economy, which, it's currently just stuck in the banking system. So the Fed has now become the money market buyer of last resort, and the Fed's QE forever, again, flooded the system with massive liquidity. So banks have to park that collateral and money somewhere. Can go back into the reverse repo example, and in a reverse repo agreement, let's say somebody has cash, the other person has collateral, let's say in short-term securities or something like that. If you want to make a very low return on your cash in exchange for that collateral, you can engage in a repo agreement and swap it out in exchange to having claim on that collateral. So what happened is there's just so much money out there and not enough collateral that money market fund rates were threatening to go negative. In order to counter that, the Fed raised interest rates on their repo agreements from 0 to 0.05. And that was enough to literally cause over $1 trillion to enter the Fed's repo system in a very short period of time, which just shows how hungry for yield the world is. It's enough to go from 0 to 0.05 to raise over $1 trillion if you're the Fed. So going back into it, as we well know, the Fed tries to be forward-looking. There's a lot of potential inflation out there, a lot of QE. The economy is fairly hot. So the Fed is finally starting to see that maybe it's time to step away a little bit from all this liquidity. And in the June FOMC, the Federal Open Market Committee, they said that various participants mentioned that they expected the condition for beginning to reduce the pace of asset purchases to be met somewhat earlier than they had anticipated, which is Fed speak to, we may taper QE. And I would be looking for Jackson Hole, Wyoming, which is where they typically announce those kind of policy changes. That's happening at the end of August. So that's an event that I would be watching quite a bit to see. It's actually funny that we did this chart for this call now a week and change ago. And since then, there was a small drop in the S&P, about a 2 to 3% down day right there. Then in the last 2 days, immediately gotten back up. So it's one of the things I'm looking at is how much money is in the system and what's the market psychology. So you see, on one hand, that's the VIX, or volatility index pricing of options. And then here in orange is the S&P 500. So post-COVID, we can see that volatility has started to decline, and the sizing and time of corrections goes from a few weeks and becomes shorter and smaller and smaller and smaller, and just recently, just 1 day. And this latest correction continues that trend where the market went down just a few days ago by 2%, and that also lasted just 1 day. Volatility has gone decline immediately, and all that money in the sidelines just uses every and any opportunity to jump right in. How's that going to end? I guess we'll see in Jackson Hole, Wyoming. QE impulse is likely to decline from here. So projection for central bank liquidity is in fact on the decline. And we can see that into the following year, there's still a lot of QE, more than happened in 15, 16, 17, but still declining from current levels. So again, my projection is that they may actually announce some sort of taper at that time.
They just need to get Itai on their board, maybe one day.
Maybe one day. All right, guys, I want to jump into our main topic of the day. These are hedge funds. What are hedge funds? How do we look at hedge funds? What's the Equi Hedge Fund Portfolio? We've gotten a lot of questions. So I figured we should take the time to dig into it And basically, let's do it. So a hedge fund is just a fancy name for an investment partnership that, unlike some more regulated partnerships like a mutual fund, has the ability to invest in a very wide range of asset classes and pursue a lot of different strategies. So there's basically a fund manager who's typically known as the GP or the general partner. Investors are known as LP or limited partner, and they just pull their money together into a partnership that can invest in many different things. So a hedge fund can invest in anything, which what makes it so nimble and such a good structure to have. It can invest in raw land, can invest in real estate, currency, derivatives, stocks, even art, NFTs, that's new. If it exists, a hedge fund can probably invest in it. So I want to dive really quickly on the history of hedge funds. This will be fairly brief. If you're interested in more, you can feel free to just read the slide. But the first hedge fund was created in the 1940s. Alfred Winslow Jones, he was a very colorful character. He actually fought in the Spanish Civil War and was a Marxist for a little bit. And then he turned into, I guess, a capitalist by forming the world's first hedge fund. And his thesis was really interesting. So the way you think about investing, there's two types of risks in the market. There is the general market risk, which whatever it is, the business or the stock that exists in the stock market, it's impacted by the general market. So let's say, Coca-Cola's business is not going to be impacted generally by on anything specific for that day, but there's a macroeconomic event that caused the entire stock market to drop 5%. Let's say lockdowns from COVID. So Coca-Cola stock, even though there's nothing to do with the business of Coca-Cola itself, is going to drop that day. And that's called market risk. But there's also individual stock risk, which means that Coca-Cola's business is impacted because Mayor Bloomberg decided that in New York City, you can't sell sugary drinks anymore. And that specifically impacts the business of Coca-Cola. So those are two very different things. So he says, and he has the first idea that says, what if I can separate the market risk from the stock risk? So if I just pick really good businesses and buy them instead of buying the index, and then I take those businesses that I expect to fail over time because they're not run efficiently and I sell them short, so I bet against them, I in fact create a portfolio that's resistant to the market, because if the market falls on one day, my shorts fall and hedge the longs. And then over time, I'm just going to grab the stock selection effect, or I'm just going to separate the stock risk. And that was a total revolutionary idea that effectively creates the world's first long short fund that still is one of the best performing to have ever existed, because at that time it simply had no competition and indexing wasn't really invented yet. So then in the 1950s, an interesting idea came out where basically, on one hand, if you can use leverage and use that leverage to hedge your bets in the other direction, you can in fact increase leverage and reduce risk. Pretty crazy concept, but that's when that gets started. Same guy that basically created it, Jones. Also, he came up with the idea of charging a 20% performance fee, which by no means is a new idea. So how does a hedge fund structure kind of works? So on one hand, you have the general partner, and that general partner typically is comprised of investment professionals that manage the investment, and they get to charge the carried interest and the management fees. And then you have the pooled investment of limited partners, and they're comprised of individual clients, limited partners, that they put their capital interest, and then the partnership goes together and invests in all the different companies and investments that they can.
So Itai, this would be like, hey, if somebody came and invested with Equi, Equi would be the general partner, and everybody's individual check would be the LPs, and it would be on Equi to make the investments in all these underlying companies or funds. Is that kind of how somebody could think about it?
That's exactly how you think about it. And then the way it works is that the partnership together, including the limited partners, actually owns the underlying interests in all those different investments.
Got it. Thanks.
Sure. So let's talk a little bit about carried interest, which I think is just an historical anecdote that is really interesting. So carried interest is what allows the manager to be compensated from the profits of the fund. And then those proceeds are actually taxed as capital gains, and they're not taxed as income. And Jeremy, you want to talk a little bit about the history of carried interest?
Yeah, so if I remember it, these were a bunch of Venetian merchants who would actually carry on board the ship their 20% of all the merchandise that they would then go out to trade. Is that how it worked?
Right, because they didn't know if they're going to make it alive or not from the journey to like far away India to get the spices. They would typically make 8 to 15x the profit on what they were able to bring, and then they were able to take 20% of whatever it is that they were carrying on their ship, hence their carried interest in the actual commodity and merchandise.
All they had to do is navigate some seas and risk their life for their carried interest. How the times have changed.
Very similar to trading VIX instruments. No, I'm just kidding.
Nice trader joke.
All right, so in the 1960s, rise of hedge funds, this is where you see people like George Soros coming in, which I believe is the second most profitable trader that has ever lived, or his second most profitable fund, followed by Jim Simons's Renaissance medallion, that it's on its own could deserve a slide. Won't put that here. 1970s is when the hedge funds first start crashing with a series of bear markets. Things get more interesting this time. The rise of Ray Dalio starts. Resurgence again in 1980s, interesting markets for hedge fund. And then in 1990s, hedge funds really boom, and you get a lot of the really famous ones today, such as Stevie Cohen and others. In the 2000s, hedge fund become mainstream and become a go-to for institutions, endowments, pension funds, etc. And then 2010s is the era of regulation. It's become a lot more difficult to start hedge funds and to maintain them and things like that.
Itai, why do you think sometimes hedge funds get a bad name when they shouldn't?
So I think there's two reasons for that. One is that performance is in the last, generally, I'm saying generally, there are obvious managers that perform very, very well, and we'll dig into it shortly. But performance has been dragging for a lot of those hedge funds. And I also think that Bernie Madoff has basically given the industry a really bad name in general. But a lot of those regulations have changed since, and it's become a lot more difficult to, which is a good thing. It's become a lot more regulated and a lot more difficult to do what he did. And I think that's the main reason. I also think, unfortunately, that a lot of hedge funds have become expensive index trackers. And I think that's one of the reasons that some of these hedge funds have a bad name, because they're not really doing what they're supposed to do or getting paid for.
Thank you for that.
So the hedge fund industry has grown quite a bit from 1990 with a few billions to well over 3 trillion today, which is a sizable industry. If you look at the AUM by area, North America leads the charge by far with 2.8 trillion, Europe just about 700 billion, and all of Asia Pacific just 120 billion, and the entire rest of the world with essentially almost no hedge fund exposure at all. So let's talk about that performance. I think that's really, really interesting to note, because if you're investing in something, you really want to know how it performs. So in the short term, hedge funds have failed to do what they were supposed to do. And they've been a big source of disappointment. So you can see here the S&P 500 going into 2019 in black, and then the entire HFRI weighted index only returning about 60% or so, dramatically underperforming the S&P 500. But when you're looking at hedge funds between 1990 and 2008, that's a totally different story, where even the HFRI index of broad funds not only beat the S&P 500, they've completely avoided the dot-com bear market, and they've done exceptionally well. It's actually interesting because there's somewhat of a correlation too between value and growth, where you also saw a pretty big decoupling between value and growth stocks after 0809. And it seems that the majority of the HFRI index is following more on the Benjamin Graham kind of like growth stock approach. And that just hasn't worked in the era of vanguarding QE and money printing.
Got it. And it's also safe to say that this growth that we're seeing from 1990, a lot of kind of what we talked about in the past is by avoiding the large losses, even if you're not necessarily making as much each year, you avoid the major drawdowns, and thus you can end up at a higher point. Is that kind of how we should be thinking about this?
Yeah, there's definitely a big impact there because the majority of hedge funds, so HFRI index was essentially flat during that big bear market where the stock market dropped about 50% and then it compounded from a much higher level. So that definitely plays a big role there. Good observation.
Cool, thank you.
So what we do in Equi, given the fact that the index itself is definitely not the place to invest. So, when you're looking at the HFRI index, I don't think that level of performance and correlation too actually provides the proper the proper thing we want to do. So unlike the public markets where indexing is a potential approach that you can take and you'll do just fine by indexing the S&P 500, even though you can make the argument that today with 30% being 5 stocks, that's not the best approach either. But let's go back into the past 20 to 30 years. Indexing has been an exceptional piece of advice. In the private markets, indexing doesn't work because the index itself is not efficient. The markets are not efficient. And the game consists out of actually finding the top performers that have a niche, that have a repeatable process that you can target, and you can stack them all together to create a better portfolio. So that's how you would do it. So you can see just in the United States, there are about 10,000 different hedge funds. And they're now controlling actually $4 trillion. So that slide from before was not updated. Manager selection, therefore, is key. So this is an example of one manager that we have on platform, where on the red, you can actually see the S&P 500 index from inception here in 2003. That's the inception of both of this manager strategy when he started trading. And then in green, you can see his cumulative returns or his performance chart versus the S&P. What we have in blue here is something we like to use as the cumulative outperformance. So we stack those two together to see when does this manager outperform and how much. And it's very easy to see here that this manager was able to stay non-correlated and actually profit from the bear market in 07 and 08, which added dramatically to his outperformance. And then he consistently stayed outperforming, and then he benefited again from COVID. So this is a really good chart that shows you that this manager is able to capture both the downside and the upside in the market, effectively staying with the S&P in the up times and benefiting from the downtimes. And this is something that we really, really like and appreciate in a manager that can do that. And another way to see this is the same manager. We actually chart, starting here at inception from 2003, statistically, the area of outperformance versus the market. What I mean by that is how many months in this period since 2003 was he able to outperform the S&P? And that was actually 82% of the time, where underperformance happened less than 5% of the time, and the rest was neutral, which means he performed just on par with the S&P. I think that's incredible. And as long as you can find enough people like that, which there are enough people like that, you can build a really competitive portfolio to the HFRI index. So let's talk about the benefits of diversification. So what is diversification? First of all, the way I think about diversification is different than saying, you know what, I have Apple and I have Coca-Cola, so I'm diversified. No, because as we've seen from that slide about Alfred Jones, that's still susceptible to market risk. So if the entire stock market goes down, you're not diversified. So the only way to truly be diversified is to come up with non-correlated strategies to what you're doing. So on one hand, you have the pure correlation with the S&P, which is just basically owning the S&P outright. And then on a perfect -1, you have shorting the S&P. That's a perfect at -1 correlation. And then in between, you have a whole universe of different funds and different strategies that can sit anywhere between the -1 and +1 scale. So the game consists of finding enough of these funds that share those non-correlation so you can build a total portfolio that is effectively as close to zero as possible.
And when it's as close to zero as possible, why is that a good thing?
Because the lower correlation you have with public equities across the portfolio, it doesn't matter if the market goes up or down or sideways. you're always consistently having return drivers that can compound capital on a consistent basis. So when it comes to correlation, you want to be as close to zero as possible. So this is characterized here by the efficient frontier. And the efficient frontier is basically a measurement that here on the y-axis, you have your annualized returns going from 6 to 11%. And on the x-axis, you have your standard deviation, basically a measurement of risk or volatility. So S&P 500 falls up here, about a 10% return and approximately 15% risk per given year. And what's interesting is that if you actually have the HFRI index, so you're combining three things: S&P 500, the bond market, and the HFRI index that we've seen is not even that efficient and not even that profitable, you are still able to keep almost the same level of return, just slightly lower, but you're effectively cutting risk in half. And the reason is because your chance of drawdown at any given moment significantly declines, and then you can still compound capital effectively without interruption. So you don't get that loss that Jeremy pointed out that happened on that chart from 2000.
And Itai, just to make sure we're just reiterating, when you see standard deviation at the bottom, 2%, 4%, 6%, how should somebody interpret that if they're thinking about risk? What does it mean?
It's basically your chance of loss on a given year. So imagine you have $100 that you're investing and you're hitting that 10% mark. That means that now you have $90 that you're investing with. So it's a measurement of how much money you could lose on average on a given year.
Got it. It's the measurement of loss each year. So the higher you are on it, the more you can have a loss, and the further left you go on the standard deviation curve, the lower the maximal impact will be. Right.
Therefore, the most efficient frontier would be all the way top left, which some people say is impossible or very difficult to manufacture, and that's what we try to optimize for. And the only way to optimize for that is stacking as many non-correlated investments that perform well on top of each other. So let's talk about the different hedge fund strategies, and you can actually see their proportions. So equity strategies like long-short strategies, very famous funds that do this are 43%. That's the majority of the funds. They're essentially stock pickers. One of the problems with that strategy is it's become very crowded, and as a result, the returns in that strategy has come down. This year, some of these strategies blew up very famously with stocks like GameStop that were notoriously short squeezed by Reddit. That would be a part of this category. Then you have credit strategies that basically do private market loans and things like that. And you have many different types. Let's continue here. And what's interesting about those types is that effectively the correlation is key. So if you look at the different groups here, you have the CTA index, currency traders, etc. You can see here their measurement of correlation to the S&P 500. So that's a good place to start. Look at a specific category or strategy and then figure out who is actually the top performer there. That's a good way of doing this as well. So let's look into what Equi does in order to find the right hedge fund portfolio. I won't go too deep into the search criteria, but you can see here that we have about 10,000 funds plus that we're actually searching. And one of the things that's important to us is that the fund AUM is typically sub 500 million. The reason for that is that as you scale up and you grow your fund, most fund managers are going to scale horizontally. So they're taking the same thing they've done and just try to push more money into it. And there's a problem with that typically a strategy can't scale indefinitely. And as a result, the returns decline. Also, as you grow and grow and grow, you kind of become fat and happy, and you're not as focused in research and other things that give you that edge, and returns seem to decline. So we stay on the lower AUM level. And because we do, we want the manager to have a long track record of more than 100 months. So how do we look at funds in Equi? Let's take a look into the Equi's portfolio. So we start with a universe of 10,000 funds and more, actually close to 15,000 different funds. And we use a lot of different ways to get them. We either scrap data ourselves, or we use different databases, and then we basically pull all that information together. And what's important to do is first the data approach. So we're looking for performance, we're looking for data right away. one of the things that's important for us is that we typically look at managers that are sub $1 billion and sometimes 200 to $500 million. And the reason is that when you scale your AUM too much in the hedge fund game, typically the way it works is it scales vertically. And that means that when you have a strategy that's obviously working because you're able to raise money, managers tend to just put more money into the exact same thing. What it tends to do over time is actually lower returns, because a strategy typically just has a capacity for just an X amount of money. And when there's too much money in it, the returns tend to diminish. The other reason is that as managers become really big, that 2% management fee becomes quite a bit of a management fee, and the incentives to go out and do innovative things and look for more strategies diminishes. So as a result, we figured if we find those long tail managers that are a little bit lower in the AUM, we're going to have a comparative advantage. At the same time, what we want to do is make sure that they have a long track record. So we're looking for managers still with a long track record and a little bit on the lower AUM side, to basically find those long tail managers and bring them to you. So when we do this, the search looks something like this. You have all these managers here to the left, and then we weight them and rank them by different things. So on one hand, you see their annualized returns, and then on the other hand, you see the annualized volatility. So what we want to make sure is that their returns and volatility are basically aligned in a good way. So the reason this is the best fund in the world is because the Sharpe ratio is 6. So a Sharpe ratio is just a measurement of risk taken versus reward received, right? So what kind of risk you're taking per unit of reward. And because this fund is able to produce 18% a year with just 3% risk, they've ranked really, really high on that scale. Another thing that's really important is to make sure that the correlation to the hedge fund category they're in, as well as the S&P, is very low in order to build that best efficient frontier that we talked about earlier. So the way we do it and the way we decide the allocation is mathematical optimization. So we know that on one hand, we want to reach the best expected return. And then on the other hand, we want to reduce volatility as much as possible. So this is what guides us in order to decide how much to allocate to each fund and how to build it up. And the end result for the equity portfolio looks like something like this. We're sitting at about 17%, and I would say gross of equity fees, 17% on the expected annual return scale, with just around 3% annualized volatility. So how is that possible? It's possible because we're stacking all these different investments on top of each other, and reminding you again that each one of these investments is not correlated to one another. So
Itai, I just want to make sure I'm understanding this. You're saying within the equity portfolio, the average return has been 13.34%, and then your volatility, that just means that, hey, the max that at least this sleeve draws down in a given year is only 3%. Is that how to interpret this data?
Historically speaking, yes. Obviously, past performance is not indicative of future outcome.
Actually, Jeremy, you said 13%. It's actually 17%.
17%. My bad.
Yeah.
So here is the S&P 500 sitting with historically about between 8 and 9% return and about 16% volatility. Here's the bond market sitting with about 6% volatility and 4% return. So in fact, you're able to almost reach double returns than the S&P with actually less volatility than the bond market.
Can you explain how this reconciles with like the sort of tribal adopted wisdom of like, you can't beat the market? Like everyone, like you always hear people like Warren Buffett, and you kind of just hear like the kind of headline news saying things along the lines of like, active managers can't beat the market. Could you maybe give some insight in terms of like, what are the actual strategies behind these funds? Like, are these the type of strategies that normal people can get access to, or is this like totally off the beaten path?
So Warren Buffett beats the market all the time. And he actually has a stock picking strategy that has historically beat the market. I think his exact advice was, if you don't know what you're doing, you can't beat the market, and you should just index into the S&P 500. And I think that that's not true at all, because we see all the time different funds that have beat the market and are able to beat the market. And again, we stack them on top of each other, which gives the equity portfolio such a good risk return criteria. So what are the different strategies? A lot of people have actually asked me when I presented this on a demo, why do you want an investment that has higher volatility and lower returns than the S&P 500? So again, I'm giving you back to that efficient frontier. And in this efficient frontier, negative correlation is sometimes very important. So this is actually a tail fund that only makes money when the market goes down and has done exceptionally well in COVID and other periods. I think it's very impressive that in the last decade, a period where it's been one of the most raging bull markets in all of history, a fund was able to produce 6% a year while only making money when the market went down, which didn't happen very often. So imagine when we get the really next big bad bear market, this fund's performance is going to improve dramatically. So these funds do anything and everything. Some of them do private credit loans and are in the center of deal flow. Others do commodities trading that are totally uncorrelated, trading things like wheat, corn, soybeans, gold, platinum. Other funds do convertible arbitrage. So they basically arbitrage the capital structure of a company. And I'm going to actually give an example of a fund that's in our portfolio and the due diligence we do in order to reach that fund. So this is the category level asset class allocation that we have in this sleeve. So you have the equity hedge, relative value, macro, CTA, and fixed income. And you can see that not only they're not correlated to the S&P, but equity hedge and relative value have no correlation to one another, no correlation to macro, CTA, fixed income, very low correlation across the board, which is why we're able to have such a good efficient frontier. And this is when you compare the correlation of the broad portfolio to the S&P index at just 0.16 with a beta of 0.03. So again, you want to get as close to zero as possible when you're constructing that efficient frontier.
And what can you say about an individual investor's ability to invest into any of these funds? Like, what are the barriers to entry there? How possible would that be?
So it's borderline impossible. I would give you an example. One of these fund managers that I reached out to said, how did you even find me? I have never done any marketing and I basically do it for friends and family. That's one barrier to entry. The second barrier to entry is understanding those strategies, analyzing them, doing the due diligence, and then basically figuring out who's correlated, who's not correlated, how you stack them together for an efficient frontier. That's all kind of like on the due diligence side. But there's also issues with minimums and regulatory barriers where some of these funds are what we call qualified purchaser fund or 3C7 funds. Those kind of funds are only open to people that have $25 million in net worth or more. And a lot of them would take minimums of 5 million or more. So, anywhere between 1 and 5 million. So one of the issues with that is that if you wanted to invest on your own, and let's say you only had $5 million, you're not going to put literally everything in a single fund. So in order to reach a true diversified basket of 10 funds like this that are totally non-correlated to another, you probably need family office money to do that, which is north of $100 million in order to be appropriately diversified. And even if you had that, you still need to find them and have the analysts to do the due diligence. So it's just an extremely meticulous process.
And there's the whole issue too of, will they even take your money? Because sometimes these funds are full and getting in is a major challenge.
That's exactly right. I mean, it took us months and months of a sales campaign on these managers to basically, there was one manager I called for 5 months straight, once a week, calls, emails, until he finally took a call with me and we were able to get an allocation. So we can see how this portfolio gets impacted when we do the stress testing, which is a really key part of it, because a lot of times things appear non-correlated, but then when the market really goes down, correlations tend to pick up. So even things that were seen as not correlated could all of a sudden become correlated, which was the case in COVID or during Lehman and things like that. So what's important to do is then stress test the portfolio across all the major losses of the market over the last 15 years or so, which were some of the worst months ever experienced, like Lehman, October of 08 or March of 2020 with COVID shutdowns, and basically make sure that the portfolio is in fact not correlated. And if there is some kind of correlation, then you can tweak the efficient frontier and add some non-correlation aspects in order to have the most optimized portfolio. So you can see here in the blue are all the worst losses in the S&P and when they occurred. So for example, that would be October of 2008, when money markets froze and Lehman Brothers collapsed. This would be March 2020 here in COVID, February of 2009. This would be the flash crash in May of 2010. So multiple events like this. And you can actually see that this portfolio weathered the storm quite well, even producing some alpha in periods like October of 2008, and predominantly having the best return in March of 2020, mainly because some of the tail funds that we use were up over 50% exactly when you need them the most. And I think that's what makes the portfolio truly unique.
And Itai, could you really quickly just talk about what a tail what a tail fund is and why that would be important as you're thinking about your composition of some of these portfolios?
Yeah, so a tail fund would be a fund that just strictly has a mandate for being negative correlation. So there's the non-correlation, which means that no matter what the market does, this just does its own thing. But there's also negative correlation where when the market goes down, the investment mandate of the specific fund is to go up. And some of these tail funds use options and derivatives that they have basically convexity, which is a fancy way of saying exponential returns. So let's say if you have derivative hedges in place, when a COVID event can happen, then you can make 10, 15, or 20x on the amount of money at risk for the specific fund. So this is why these funds tend to kind of like chug along during the bull markets. If they're a good fund, they would just chug along without really losing too much. But then during the big shock events in the bear markets, they're going to make exponential returns.
Got it. Thank you.
Sure. So then we look at the total portfolio's performance and outperformance. So just like we showed with the one manager, we start here in February of 2008. So you can see equity portfolio in green versus the S&P index in red. And then the blue would just be the cumulative outperformance. So the whole idea is to create a portfolio that just has consistent outperformance over time. And in fact, during this test period from February 2008 to early 2021, this portfolio have done 5 times better than the S&P 500.
So I want to highlight this really quick. This is what I'm seeing. First off, the green line completely outpaces the red line as evidenced by the cumulative outperformance in blue. But what I notice is that the smoothness of the line seems to just not have the variability up and down. So when you talked earlier about the volatility of the portfolio, is this what you're talking about? When there's lower volatility, you see more of the smoothness, and as a result, you're compounding from a higher and higher place each time?
That's exactly, you literally nailed it exactly right. So the reason this portfolio is able to outperform so much is because of that smoothness. So if you are consistently generating positive returns, let's say 90% of the time, you're always compounding at a higher and higher level, because every time you experience a loss event, you're effectively killing the compounding ratio. So let's say an 08 kind of event that happens in the market here, right? You lose about 50% of your money, or the market lost about 50% of its value. So if you have $100, now you have $50. So you effectively need to now make 100%, $50, to get back to where you were originally, which is why it took the market about 5 years or so to get there. So if you're able to avoid that, as you see here, and just consistently compound in an uncorrelated way, over time, you're going to compound much more. Even if in an individual year like 2013, stock market has beaten the equity portfolio, and that happened in a few other instances, because of the smoothness, the lack of volatility, and the consistent compounding, that's what allows over the long run dramatic outperformance. That's really the secret.
Yeah, and it also looks very interesting come the March of 2020 when the market takes a big dip, and then you get some of the actual alpha in that situation. You can see that incredible rise in the blue line closer to March of 2020. That's very interesting.
Yeah, basically, and just having somewhat of a positive performance and not really losing money creates a lot of outperformance versus the S&P. And then we measure it over the time horizon. So over the last 3 months, this portfolio has done better in 52% of times than the S&P. In the last 6 months, 57%. And then you see as you go into the longer time frame of 12 months and 24 months, the outperformance literally happens 71 and 78% of instances. So, all right, a little bit of a bonus. We're going to dive into an individual fund's due diligence to actually look into an example of what a fund may look like and what this fund typically does. So in this instance, you can see this is a very unique arbitrage fixed income fund. You see here in gold versus all the global indices. This is from their actual due diligence material. Here's a way you measure drawdowns. So you can see the global index here in 08 dropping 50%, where this fund dropped about 10%. And cumulative performance in this fund since 2003, up 767%, quite incredible, again, because of compounding effects. If you drill it down, 13.4% a year, which still beats the stock market with significantly less correlation. They currently have AUM of 750 million euro. You can see here their total performance since inception in 2003. And you can see even here, the drawdowns are not too big, and the returns are very consistent overall. Even 08, for example, their only down year in record, just down about 4% versus 50% in global markets. So you can see here their efficient frontier here in gold, top left, where you want to see it compared to other world indices, volatility of around 6 or 7% per year and returns that are close to 14% a year. Here you can see their long-term performance versus the global asset class. So again, performing better than the S&P 500, MSCI World, high yield bonds, global bonds, with significantly less volatility. So what's important to understand is that the due diligence period goes far beyond just making sure performance is good, making sure the correlation is good and things like that. There's also business due diligence and operational due diligence. So how do we know that their reporting are actually correct and real? How do we know that they have the right business proceedings? So this is where we have to go into the terms. So in this case, we can see that the fund only charges performance fees if they approach a high watermark, which means that in order for them to charge, they have to continuously perform and exceed their highest performance ever up until that point. Also, we see that we don't have a significant lockup. We're able to withdraw money within a 30-day notice, and we actually have monthly liquidity. Which for a fund like this, it's absolutely incredible terms. Then we want to make sure that they have a reputable administrator. So their performance is reported to us by a third party that is trustworthy. So we know that their books are accurate. So in this case, they use SS&C, which is the largest in the world. And then those funds are getting audited by KPMG, which needless to say, is one of the largest accounting firms in the world. So we actually have access to their audited financials, and we can verify that in fact, what they say that they do is what they really do. So that's a really important part of operational and business due diligence on top of just seeing what the returns are. So what do they actually do? I've been asked this quite a bit. So we're going to go into a trade example of what a fund like this may do. To give you an idea of how they're able to create returns that are this incredible in a very interesting place, which is Scandinavia. So here's the fund to the left. So they get money from investors. And then they're going to basically take that cash and buy a bond that at whatever time when this bond was issued. So let's say this bond may have been issued 20 years ago, expires in 2022. When it was issued, it was yielding 4.5% rate. Today, it's significantly less, but nonetheless, they're able to buy this bond with the expected expiration of 2022. I believe this is a Swedish housing market bond in this case. So now they own the bond and they have a fixed yield that they're going to get between now and 2022 of 28 basis points or 0.28%, which doesn't sound like much, but we'll see how we're able to create much higher yield from that. That yield goes back into the fund. And then this fund, the greatest risk that can happen right now is if interest rates rise, because if interest rates rise, because it's a seesaw, interest rates rise, the price of the bond will fall. So what they need to do is hedge the interest rate risk. So they're going to take 23 basis points from that 28 basis points and pay for an interest rate swap, which is effectively an interest rate hedge. When you do that, you're going to receive a floating coupon of 1 basis point. So net right now, there is something along the lines of 5 basis points that is profitable, which again is not much, 0.05% or so. And what's going to happen now, and this is the interesting part, they're going to get into a repurchase agreement or a repo agreement. Jeremy, do you remember what that is?
I would like for you to just tell it better because I'm going to say it and stumble, but I know that you'll say it very clearly.
Okay. A repo agreement or a repurchasing agreement is basically you have 2 sides. You have one side that has collateral, which usually is treasury bonds or short-term securities, could be mortgage bonds, whatever. And then the other side has cash. So the side with the cash wants to get paid for that cash, but they want to lock up money for a very short period of time. So what happens is that the side with the treasuries or the securities is going to want to have liquidity. So what they do is they create a swap or a repurchasing agreement where they basically swap the two, the cash for the collateral. And then typically there would be a very small rate that's going to be charged for doing that. And typically the side with the cash is going to get a very small rate. And the way it's secured is if the side with the collateral no longer has the ability to buy it back, then they basically take over the collateral and they can sell it in the market. So typically very short-term securities, bank do this quite a bit and things like that. But in Scandinavia, we have an interesting world of negative interest rates. So as crazy as that sounds, when you do a repurchasing agreement like this and you swap out the cash for the collateral, when you're supposed to actually pay a variable rate, it's negative here because you're actually receiving that funding rate because the short-term interest rate environment is in fact negative. So you've basically taken those bonds that you had, you've created a repo agreement, and in which you've gotten collateral, so you've gotten cash. I mean, you've given away your collateral, now you've gotten cash, and you've gotten paid to do that. So in order to get cash from your collateral, you actually got paid 23 basis points.
Who do they make this trade with on the repo side? Do they do it with a bank or their central bank?
Yes, it's through the bank and the central bank. That's why they're able to do that. And then essentially they're left with more cash because now they've put the bonds as collateral and they have cash again, and they can recycle this whole thing to achieve leverage. And this is how a certain amount of 30 to 50 basis points becomes a consistent 1 to 2% per month because they're able to utilize and harvest the system while hedging all sides.
That's really interesting. So just a few quick questions. So the bank that would take the bond in the first place, they would only need that as collateral to be able to issue their own loans against, right? That's the only reason why they would do that.
Yeah, plus they would actually want to have less cash on their books because in a negative interest rate environment, they would actually pay more to hold the cash. So if you think about some of these markets, they have a negative 50 basis point federal fund rate. So if they're actually holding that cash, they have to pay for it. So they want to have the least amount of cash possible.
Oh, interesting. So it literally makes sense for them to pay somebody a little less. Otherwise, they were going to get punished a little more.
Yeah. Mm-hmm.
So these type of strategies now in a world of negative interest rates could become more compelling options that exist out there
in order to still utilize and make good yield off of a very low interest rate world. So yeah, this is just an example I thought was interesting because it's a very original way of thinking about some of these assets and a really interesting way of generating yield.
Itai, you're going to have to spend a little more time in Scandinavia and in Europe and figure out how to arbitrage these negative interest rates.
If we can only get a negative interest rate loan for our multifamily, right?
One day, that is my dream.
All right, guys, thanks for watching the rerun of the call, and hope you enjoy. We'll see you in the next call.